Okay, in this video I'm going to talk about how what we're going to call the golden ratio to spot long-term turning points in gold. To lead into it, in general as an investing concept, you need to understand that if you want to beat the market, what you need to do is invest in sectors and asset classes that are outperforming the U.S. stock market averages. And to do this, the most common way is to look at the relative strength ratio, to use that for analysis. So for example, this is a chart of XLE, the oil stock ETF. Below it, you can see the XLE divided by S&P 500 ratio. That's a relative strength ratio because when that ratio is trending up, it means that oil stocks are outperforming the S&P 500. You can see how that happened from 2006 to 2008. And in 2008, that's when the price of oil had skyrocketed over a short period of time. What's interesting is that we made the peak in the ratio, and really that ratio's kind of been trending down ever since. In 2011, it's really underperformed the stock market, and that's been for 5 years. What's interesting, though, is despite that, investing in oil has been one of the hottest topics in the financial media and one of the most popular trades in the stock market for people to try to do. They've been attracted to the dividends in these stocks. And also, if you look at ETFs ranked by daily volume, almost every single day for the past year at least, the energy ETFs are among the top 10 being traded in terms of volume, despite the fact that they're really underperforming the stock market. Now that's going to change someday in the future, and it's possible that this ratio is making some sort of bottom now, but that's a process that would take months to play out, perhaps the entire year if that's what's really happening. Now, if you think about biotech stocks, though, it's been a totally different story over the past couple years. Now, biotech stocks lagged the stock market from 2009 to 2011, but then all of a sudden something happened, and the biotech sector vastly outperformed the S&P 500 from 2011 to 2015 in July of that year, when actually the stock market made a significant top itself. What happened in biotech then is that biotech was really the leading sector, the leading speculative sector of the stock market, much like internet stocks were in the late 1990s. Now, if you recall, though, when the stock market topped out in 2000, internet stocks lagged on the way down. Interestingly enough, biotechs are now doing the exact same thing. They're now underperforming the stock market, so they're no longer really a good thing to buy at all, even though they had been for years before. What this suggests, and a takeaway, is that changes in the trend of the relative strength ratio leads to buy or sell signals for the long term. So biotech is something to stay away from, but in 2011 it was something to start to buy. So this is a way you can use relative strength ratios to identify what are going to be future leaders to buy, what can break away from whatever the stock market is doing. If you can recall in the earlier video, we've seen how gold itself does not really trade in the long run with the stock market. It really doesn't. Yes, there are days when the stock market's down and gold is down or vice versa, but in the long run there really isn't a consistent trend there for gold in the stock market, which is good. It means it means gold is an uncorrelated asset for an investment portfolio with the stock market. However, gold does have times in which it breaks away from the stock market and just goes up, even no matter what the stock market is doing. That's the greatest time to invest in gold. So in the previous first video here that I did, I showed you how gold was in this big bull market that really started from 2002 and lasted for several years. It was a wonderful time to invest in gold. Also had a big run from 2009 to 2011. But you could use relative strength ratio in gold in the S&P 500 to identify the start of that bull market in 2001. So what you see in the chart above is the price of gold, and then below is this gold divided by S&P 500 ratio. And I want you to notice that that ratio went sideways. You could say it formed a stage 1 base in 2001 and 2000. What's significant, though, is during that time the stock market was declining. So this relative strength ratio is showing a positive divergence away from the stock market, which was a tip-off that a breakaway bull market in gold was about to come, and it started indeed in 2001 and really accelerated in 2002 with this ratio going up for years. So that's a long-term buy signal for gold in regards to the stock market using this what we're going to call the golden ratio here. And here we go again. Over the past couple of years, what's happened with this ratio? Well, it had a huge spike up in 2011 when gold all of a sudden went from $1,400 an ounce to $1,900 an ounce in the space of just a couple months. A parabolic move that took place in gold. The ratio peaked out and it declined really for 4 years, really 5 years here. And that meant that if you just wanted to say what's a better investment, the stock market or gold, during that time the stock market was. However, this ratio has now significantly began to turn up during a time in which we've seen weakness in the stock market, similar to what we saw at the start of 2000. That suggests that we are seeing this alone as a long-term buy signal for gold. However, there's another one that's even more significant. And here we are taking a closer look at gold today. You can see the relative strength ratio did this big jump in 2016 that really started in December of 2015, or you could even say August of 2015. And the stock market made a top in July. That relative strength ratio really diverged away from the action of the stock market because there was a dump in August of 2015, and the ratio shot up during that time. It repeated that same sort of behavior in January 2016 and made a higher high. This downtrend in the relative strength ratio, as you saw in the chart below or before, was really going on since 2011, and here was a big breakaway. Is that breakaway a real significant trend change or just a temporary blip? Well, the next thing we're going to talk about is going to answer that question. And you need to realize that there are rotational patterns in regards to how things perform with the stock market and with each other. There are sectors that historically lead at tops and bottoms of the U.S. stock market bull and bear cycles. As we mentioned, gold really isn't linked to that. However, there is a trend with gold that's very significant, and that's mining stocks. Mining stocks tend to lead gold. That means that when you get to a top in a gold bull market, the mining stocks actually tend to lag during that topping phase and make a significant warning sign that, hey, flashing, we're at a top, or at least a big correction is coming. The opposite tends to happen, though, at the start of a bull market and the end of a bear market, in which the mining stocks start to assert leadership over gold, and then as a gold bull market evolves, the mining stocks tend to vastly outperform gold. So let's look at this. Here is gold in red, plotted in red above, in an overlay of black in this chart is the HUI mining stock index. And what I want you to notice is the HUI mining stock index in 2009 went up tremendously until 2011. That was a bull market that was going on. and gold also went up. However, the HUI divided by gold relative strength index, which tells us are gold stocks outperforming gold, are they lagging gold, it flatlined starting really in 2009. And even though gold stocks also made a new high in the fall of 2010, this ratio didn't. And the ratio just continued to go flat during that giant parabolic spike high in the second half of 2011. Gold made a new high. Silver prices, in fact, exploded and more than doubled in the space of just a few months. But while that happened, the mining stocks did not do that. The mining stocks didn't even make a new high. That was a sign of a negative divergence in the sector. Recall that the action in the mining stocks tends to lead the action in precious metals. So when the mining stocks did not make a new high, even though gold and silver made a parabolic high, that was a warning sign. The top was being put in, and then really a stage 3 top played out, during which this ratio rapidly deteriorated, even though gold and the mining stocks pretty much went sideways in 2011. They had big moves up and down. They didn't really have any more sustainable rallies after the 2011 peak, but they didn't collapse until a collapse began into the end of the year 2012. But there are plenty of warning signs in this deterioration in the ratio. And the ratio continued down all the way until really a bottom was formed in July of 2016 or 2015. A double bottom was formed in January 2016, and then the ratio shot up almost 50% from 0.10 to around 0.15, and it broke this trend line going back to 2011, which was so that's a potential sign of a significant trend change. And if this trend change is correct, then this ratio now is in a bull market of its own, is going to go up and up and up. That means the mining stocks are in a new bull market. They're going to explode for massive gains, much like they did from 2009 to 2011, or more importantly, from 2000 to 2007. Massive bull market, and an exciting time to be in these stocks. But how do we know, once again, if this is a blip or not? So I asked that question when we simply looked at this chart. We're seeing confirmation in this gold stocks to gold ratio seems to confirm this, but how do we know that this isn't also just a mirage? There was a move up in 2012 for a very short period of time, 2014 for a very short period of time, and here we are. Is this just a very short period of time too? Well, we can answer that question by looking at the actual rate of change that's taken place in this indicator. What that means is the space and strength of this move in a short amount of time. When a new leadership in the mining stocks versus gold is asserted in a meaningful way, it happens rapidly. And that's exactly what's happened. Below is a rate of change indicator. It measures how quickly the ratio is moving. The chart above is the ratio. It's not the HUI, it's not gold. It's a chart of the HUI divided by gold ratio. So you can see how quickly it's moved over the space of the past couple months. And below is the indicator of rate of change. You can see that there were, very small changes in this that didn't really mean anything because they stayed below 10, basically. But this time in January, the ratio busted above 30. It busted above 20 in last year, towards the end of last year. And those were moves not seen since way back in 2009 at the start of the last bull market. So the rate of change indicator is telling us that not only has the ratio moved up, but it's moved up in a significant way that happens at the start of new bull markets. So what we've learned in this video is that yes, we do have powerful confirmation that gold stocks have asserted leadership over gold, and which backs up the fact that gold has asserted leadership over the U.S. stock market by breaking away from it in a bullish manner. And that's great. It tells us we know in the long run we're starting new bull markets that are going to last for a very long time. Now, we can apply these, what we've learned here, in two ways, or three ways really. We can accept it and invest with peace of mind. We can also use this ratio to make very short-term trades using daily and 60-minute charts if you want to jump in and out of ETFs to try to make a short-term trading system. This ratio is an excellent way to do that. That's a topic we'll talk about future in this course. I don't really personally trade like that. I'll explain it later on the way I'm managing my money, but a lot of people love to jump in and out of ETFs. So I'm just putting that thought out for you. And now another way to use this ratio, which is actually the most important way, is to keep our eyes on it and not forget about it for that moment when we're going to see all this flip and become negative. When we're going to see gold stocks lag gold sometime way in the future to warn us that whatever bull market comes is nearing an end. Because yes, it's valuable, it's wonderful, in fact, to be able to invest at the beginning of a bull market, but it's also very important to take money off the table when a bull market has pretty much run its course. I've been telling people for months now to do that when it comes to the U.S. stock market, to get out on rallies and put money into gold or and make changes. But one day, someday, years from now, that's a message I will tell people when it comes to gold too. And this indicator will be the main thing that will tell us that that time has come. But that's probably way, way in the future. And I think we have huge gains to come before that moment comes. So that's what we'll be watching.